Hi everyone, welcome to the Timing Research Show for February 22nd, 2016. Today we will be talking about the 126th weekly report from Timing Research. If you have not had a chance to take a look at this yet, just go to TimingResearch.com/report and you can download this or any past report there. My name is David Kosmeter. I'm the creator of Timing Research, and today we have Neil Batho hosting for the first time. So I'm going to go ahead and turn it over to him.
All right, thanks for the introduction, David. And we got three great guests for the show today. We have Andrew Keene from AlphaShark.com. We have Jim Kenney from OptionProfessor.com. And we've got Eric the Wolfman Wilkinson from ProTraderStrategies.com. And myself, Neil, I run TraderReview.net. So maybe we can start off with Andrew, if you could tell us a little bit about AlphaShark, how long you've been running it, and a bit of your background in trading.
Yeah, I started at the Chicago Board Options Exchange in 2002, and I clerked for 9 months. Clerked a trade program with Boda Capital Management. I was a market maker on the Chicago Board Options Exchange in 3 different pits. In the last pit, I was the largest independent Apple trader from 2006 to 2009. And then I left the trading floor in 2011. Basically, a lot of the trading went insolvent. Sorry, it went electronic, not insolvent. It went all electronic, and the trading floor went insolvent, more or less. I launched my company as KeeneOnTheMarket.com, and then we rebranded to AlphaShark.com, and we run a live trading room throughout the day. Also have 13 educational courses on demand and DVD, as well as I'm on the process of writing my 3rd book.
Okay, great. Thanks, Andrew. Let's go now to Jim Kenney from OptionProfessor.com. Jim's been on the show many times before. How's it going, Jim?
Very good. Just briefly, my role is to provide the content, and I have provided the content for the Option Professor DVDs, which basically are 7 DVDs that try to explain the uses and the risks of the variety, and there's plenty of variety out there for different option trading tactics. So basically, I'm more on the education side here, not really coming up with picks or anything like that, or that type of specific recommendations, but more from the making sure that people have the requisite knowledge of all the different strategies and the alternatives out there.
Okay, great. Thanks a lot, Jim. And let's go now to Eric the Wolfman Wilkinson from ProTraderStrategies.com. How's it going, Eric?
Doing well, Neil. Thank you, and thank you for Timing Research for having me on. I started actually trading in college. I started out with a psychology degree and then started getting into trading and switched over to finance and really got into that aspect of the market trading. Moved up to the Chicago Board of Trade and started trading there in 1993. And like Andrew, left the floor probably right around 2011. And I'm now with Pro Trader Strategies, and we do educational daily videos and webinars on Fridays. What we're trying to do is just teach the retail investor on how to trade options. A lot of these guys get into trading options from the buy side, and that really is trying to swing for home runs. It just never really works out. You might have a couple of good hits, but at the end of the day, selling option strategies is what I feel is the best way to trade options. So we try and teach people that other side where you're taking on a little bit more risk, but your probabilities of success are much greater when you're selling these option strategies. And then I go in on the daily market commentaries, talk about geopolitical, economic, or market analysis, and talk about how I'm defending these strategies that may go bad, or when I'm starting to get in and out of different underlyings. So that, in a nutshell, is what we're doing. So we're just trying to educate the public as the correct way to trade options, in my eyes.
Okay, can you talk a little bit more about the sell side? So we're talking not just covered calls, but some more complicated strategies, right?
Yeah, we're doing everything. Actually, right now we've kind of gone back to our roots and getting into iron condors, and I'm going to do it. It's like a 3-part series where we're going from iron condors to this Friday we're going to be doing the iron butterflies, and then following it up and wrapping it all together into how to defend these when these strategies go against you. The idea is that if you have a lot of different occurrences, you're going to have some of these go wrong, and that's the nature of trading in general. So what we're going to do is try and talk about how you can keep that dream alive, keep collecting premiums. When you're buying an option, you get that theta decay, or what we've seen recently is that vol contraction. And if you were to have bought just even a few days ago and you get that vol contraction, you could be directionally right and still lose money. So the idea is to sell these option strategies in high volatility environments, or find the underlying that has a high IV and start collecting premium there. So you can be directionally wrong and still collect a nice theta decay when that vol crush happens.
Okay, because sometimes the decay is going to be more than
I'm sorry, I didn't hear.
what the gain would be.
I'm sorry, could you say that again?
I think I broke up a little bit there, so I'm just going to continue here. My name is Neil. I run TraderReview.net. I used to be a broker back in '98, '99, and I got out of the business because it was more about finding clients and managing clients rather than managing money, which is what I was mostly interested in, the strategy behind making winning picks. I use point and figure, which the rumor is a lot of people use in Chicago. Maybe you guys can tell me if that's true or not. I keep hearing that it is, and I use the Ichimoku cloud as well. Am I coming through here? Because I'm not sure about the sound.
You broke up on me where you were talking about the strategy that you used. I think you said point and click, something along those lines.
No, not point and click. I use point and figure, the X's and O's on the charts. I think I'm the only newsletter out there that uses point and figure most of the time. And I added the Ichimoku cloud recently as well. It just gives a little bit better entry and exit strategies there.
Yeah, I'm very familiar with it. It's along the lines of Stoudemire or market profile, from what I'm gathering, right? Where you get the X's and O's on the up ticks, down ticks, things of that nature. Mine is, I use the market profile a lot, where it's the volume and the time that it's spent at each incremental pricing area. So it's kind of similar to that, but it's not the X's and O's necessarily.
Yeah, it looks like hieroglyphics at first, but after a couple hours, it starts to make a lot of sense. I actually did a webinar when I was a broker with some guys. Not a webinar, a real seminar. People actually came to, and that's how I got into it. Okay, so let's get on to the reports now. We'll start off with Andrew. Based on any technical or fundamental indicators, would you predict the S&P 500 will move higher or lower from Monday's open to Friday's close?
Oh, Monday's open? I would like to do it from right here. If I had to do it from Monday's open, I got to say higher because I got edge on my side. But I think we move lower from here at 1938.25 in the futures. I think we had a false breakout to the downside. We took out 1804 quarter and we moved down to 1802 half, and then we completely reversed. I think this is a false breakout to the upside. I as well use Ichimoku Kinkenhoi, and on the daily chart, we're bearish to neutral. So we had a nice run up over the course of the last 6 trading days, but I think we move lower.
Okay, and let's go on to Jim Kenney. What are your thoughts, Jim?
Well, of course, we're just giving opinions here, and a lot of things we talk about may be factored into the markets already. But as far as where we are right now, this 1940 area, 1950 area, it seems like there's a possibility of going down from here if tomorrow it starts rolling over. Turnaround Tuesday could be the beginning of a pullback, because we've come pretty far pretty fast right now.
Okay, and let's move on to Eric. What do you think?
I have to agree with Andrew and Jim. I do see a little bit of upside here. This 1937 area is what I've been talking about for about a week now. I didn't think that this would happen this fast, obviously, with this big run-up we've had, but it's been on low volume. And if we can stay below that 1937 area. There's a key area on the E-mini S&Ps at 1865 where the E-mini is actually gapped, and you don't usually see that a whole lot. And I think it was pretty much because the bears shut down for a little bit. But I do see the overall economy not doing that well, so I can't foresee us really pushing higher and testing the highs that we saw a few months ago. So my bias is to the downside, and I'm short S&Ps, Qs, and the diamonds as well. So talking my position, I guess, in a sense, but at the end of the day, I am bearish to the downside for the overall indices.
Okay. Thanks a lot for that, Eric. So to the downside as well. Let me go to the question number 1. I actually forgot to ask our confidence on the predictions. Let's just go over that real quick. Andrew, what was your confidence on market up or market down this week?
From right here, I'll take 58% to the downside.
58%. Okay.
Yes, sir.
19 times out of 20. And Jim, what about yourself? What was your confidence?
With this resistance right here in the 1940, 1950 area, if this area does see some weakness starting tomorrow, then the 60-40 probability probably is a pretty accurate number, in my guess.
Okay. And Eric, what is your confidence?
Yeah, I'm probably about a 65 delta as well, so somewhere right around there, 65 to 70 delta to the downside.
Okay. I'm going to have to go against the trend here. I'm going to say to the upside. I think that we can have a breakout. The reason I think we can have the breakout is because it's such a broad-based rally. Every single sector is up today, and I think people are going to freak out and think that they're going to miss the boat, especially the fund managers out there that want to make these bonuses. I think they're scared to be out of the market and not get their bonus at the end of the year, even though it's early in the year. Also, another reason I think so is my main indicator is on a huge buy signal. The bullish percent indicator. It's the main indicator that I use. I'm going to try to bring it up real quick here on the screen share. 1 second. Does everyone see these X's and O's here?
Mm-hmm.
Yeah, okay. So this just shows right now 50.2% of stocks are in the S&P 500 are on short-term buy signals, just a short-term breakout. And if you look down here, it was as low as 24%. It's quite low. And back here in 2011, same area. And then we had this breakout here, 42%. So when this breaks out, it's really quite bullish for stocks. It doesn't mean I'm super bullish. It just means that we can rally a little bit more. I think we might actually be able to get up to about 2,000 on the S&P 500. Just trying to stop my screen share there. I think it got it. Is the chart still up, or I'm back?
No, you're good.
Okay. Confidence is medium. I'm going to go about 65% confidence to the upside. Not a tremendous amount of upside, maybe 3% or so on the S&P 500. Okay, so now we're going to go to what developing events, fundamental or technical, will you be watching out for during the trading week that might have a positive or negative impact on the S&P 500? And we'll start off with Andrew.
Do I have to start every time?
Well, we're going to start with, we're going to go reverse. We're going to go with Eric. Eric Wolfman Wilkinson will start off. Because Andrew's name is Andrew, and he always got called on by his first name in elementary school, and he cannot handle it anymore. So we'll go with Eric.
Can't handle.
I'm going to be looking at, there's not a whole lot of economic data coming out this week, so that we don't have a whole lot to go on there. So I am going to be looking at the technical aspects of this, and if we get above this, stay above 1937 in the S&Ps, that's going to wane on it. And again, if we get above 1982-ish area, that's going to be another line in the sand that I'm really looking at, 1980-ish, let's call it. And if the bulls can push above that, obviously we're going to push higher, but I think that it could go up, test that area, and push lower. So it's going to be mostly technical support resistance areas, just because we don't have any economic data come out. If for some reason the Middle East can come up with some kind of plan to shut off the spigots and get Iran to jump on board with them, then that could push oil a little bit higher, which would obviously, as the equities have been moving lockstep with oil, could allow them a little bit of freedom to the upside. I just don't see that as happening. I don't see them shutting off the spigots. I think Iran, is going to try and play catch up here pretty soon, or is trying to play catch up, I should say, and is going to pump as much oil out there onto the market as they can. They're not going to jump in bed with OPEC. And if Iran doesn't do it, OPEC's going to have to be trying to take the thumb screws off, and they're going to end up pushing oil out there as well. So I see oil kind of staying below $35 a barrel right now. Even though it's wanting to push up against that, I see that as a real line in the sand that they've got to get through. But the overall economic picture is not looking good, despite the fact of what the unemployment numbers are saying, in my opinion. If you dig down into those unemployment numbers, you have the discouraged worker falling off the payroll or off the unemployment line, so they are no longer technically unemployed anymore. And those workers that are involuntarily unemployed are now becoming involuntarily employed. And even those jobs are now starting to tighten up, where the person that was gainfully employed with a full-time job is now looking for part-time work because they can't find that job that they once had for the salary that they want, and are now actually going in and becoming bartenders and stuff like that. And as we all know, with minimum wages getting jacked up, that people are starting to go to kiosks, and they're putting themselves out of a job. So those jobs are starting to tighten up. So all of that together, along with China, I just don't see the overall economy doing very well. So that's another aspect of my bias to the downside.
Yeah, people getting laid off in the oil industry as well.
Right, the Balkan oil fields are really hurting. And I think there was like 26 rig on the rig count, negative 26 rigs operation now. So the U.S. oil industry is really going to be hurting, and that velocity of money is going to be sucked out of the economy.
That's true. Do you have any sort of opinion on oil right now, Eric? Do you have any trades on oil? Anything you want to give away?
Actually, I don't have any trades on oil. I'm looking at this $35 a barrel oil, and if something happens over in the middle, it's I'm bearish to the downside, but there's no real downside to it. It's kind of like, do you want to get long Fed fund futures and step in front of a steamroller? So if it gets above $35 a barrel, I'm going to look to play that to maybe $38.40. But as long as it stays below here, I really see it trending sideways, and the risk being to the upside. There's not a whole lot. The vols come out of oil too, so as a premium seller, that's just the risk reward is not there right now. But like I said, if it gets above $35 a barrel, I might step in for a quick long. But until I see that happen, I'm going to try and stay away from that.
Yeah, I think so too. Of what you're talking about in the 35, this looks so similar to the S&P 500. I think the chart should be up. Everyone should be able to see it. I just brought this up. 35, you got the obvious breakout here and the double top, and then right around 40 is right on the top of the cloud here, which would be a good target. But we're kind of stuck at this 50-day moving average. Same thing with the S&P 500. Let's move on to Andrew. And what developing events, fundamental or technical, will you be watching out for during the trading week that might have a positive or negative input on the S&P 500?
Yeah, as I look at economic data this week, like the other moderators said, it's a little weak. We have consumer confidence, home sales. On Wednesday, we have an oil number and more home sales, and then Friday we have GDP. So I don't think the economic data is really going to move us. I think we're going to move directly with oil pricing. And once again, I think $35 level is a huge level. I am bearish on oil. I'm bearish on the market. The oil chart looks very similar to the S&P 500 chart, where we, might have we might have bottomed down at $26. I mean, Barron's came out with an article that said that oil is going to hit sub $20 level, and that's when the oil started to rally, coincidentally. So I think that we're going to move with oil, so I'm going to keep an eye. It's one of the things I look at. Also the VIX 20 is a historical level of a mean, so keep an eye on the VIX and oil. But I think the market moves with oil this week.
Okay, great. And sorry about the comment about your name starting with the first letter of the alphabet. I'll make sure I don't call on you first every time. I'm going to go to question number 4.
Can I chime in with something here real quick? This is Jim.
Yeah, I think you skipped. Yeah.
Well, it's all Andrew's fault because all of my things are out of order now.
I'll start.
That's right. That's right. Again, this is just giving a little bit of an opinion on some of the stuff that I'm looking at here. And again, some of the stuff obviously could already be factored into price, but we have earnings season behind us. Pretty much 87% of the S&P has reported, and the interesting thing there is that overall, with the announcements and the expected, we're overall down about 3.6% year over year for Q4, and that. According to what I read, is over 3/4 now of negative year-over-year comparisons, which kind of puts the earnings situations in kind of a recession. And that is about the last time we saw these was 08-09. So that's kind of an interesting thing because earnings are obviously rather important. Other stuff coming up this week is real estate news, right, with the Case-Shiller numbers and all that. And on the real estate front, some of the insurers like MTG and RDN, from mid-year last year to January, they lost as much as 50% of their values. They're bouncing up now. But I wonder out loud, what that is saying for the real estate market if the insurers got whacked that hard over that period of time. So we'll have to see existing home sales and other stuff on real estate. But those insurers going way down may have other explanations, but they're somewhat concerning. And again, at the end of the week, what do we have? We've got the GDP estimates for Q4, and we have personal income and consumer spending, and of course that University of Michigan confidence on Friday. So, people may not dismiss, what the consumer's doing, what the GDP was up to in the fourth quarter. So that may have some activity on the volatility. If we can back off from the level we're now at with Tuesday, Wednesday, or whatever, but if we don't back off there, what you were saying about that 2020 area obviously may very well come into the cards because if we do break above these levels, going up to where the other resistance is technically up in that neighborhood may be very possible. But with the confines of this week, I think the number of 1940, 1950 area might hold up with the confines of this week. But further down the road, if the bulls get some news and if the people, like you were saying, are nervous about being out, then going up towards that higher resistance of 2020 might be in the cards. And that's my guess on that question.
Great. Thanks a lot for that detailed answer, Jim. Really appreciate it. Yeah, I think, we get back up to the 2000, even the 2030 level. That's kind of going to be the time when everyone thinks, the damage is done. I'm really happy again. Everything's great. But that's kind of got to be the place where you got those sell limit orders set. Good till canceled and just pop them in there. And we have a unique question here. What is your opinion on the Apple situation? And asking to give up the information on that phone and how it's going to apply or could apply to similar companies in the tech industry or even industries related to the tech industry. Let's go with Andrew. Andrew, what do you think about that situation?
To be honest, when it goes on TV, I turn it off. It's like listening to the Greek news. Like, I've had enough of it. So technically, I think Apple goes lower here. I think Apple, actually, Carl Icahn sold a big chunk of his position and another hedge fund guy sold his position. So technically, Apple does look weak, and I think it goes lower. Like I said, when it goes on TV, I don't really need to hear about it. It doesn't affect my trading, so I don't play it at all.
Okay. And Eric, what are your thoughts on the Apple situation?
Well, anytime government comes in and starts trying to, manhandle a company, especially as big as Apple, I have a bit of a problem with that. If Apple's going to go in there and do it with this person, the government could come out and say anybody along the lines down the future has to do the same thing, whether it's a terrorist or just somebody maybe the CIA or the FBI wants to look into. Who knows? So it's a privacy issue, and I have a big problem with that. We can see already what happened with the bastardization of the Patriot Act, if you will. So I have a problem with the government stepping in and trying to tell anybody to break somebody else's privacy. So do I disagree with what those people did and would love to get into their phones and find out what they were really doing? Then yes. But I don't think that Apple should go in there and be a part of that. Along Andrew's lines of Apple being, a trade to the downside, I'm bearish on Apple. I've been bearish on Apple for quite some time. As a matter of fact, I even talked about it on one of the daily market commentaries. My wife wanted to upgrade her phone. She was at that time where she could upgrade it. Went in to get the 6S or something along those lines, and they said that they would give her another 6 for free. That was the big red flag. And you could get a mini iPad for $100, and I'm like, okay, this is a virus on Apple. And that's when I became really bearish on Apple. As soon as they start doing stuff like that and offering those kinds of incentives, it's unheard of.
There's no doubt about it. That's absolutely a contrarian signal right there. Well, not a contrarian signal, a signal to get out. Yeah, you'll see these things. I mean, it's amazing how much you can see. I still remember I was actually in San Diego. I was walking along the cliffs in La Jolla. There's a viewpoint kind of out of Seal Cave there. I was walking along, and I was just happened to talk to someone when I got to that viewpoint. It was the exact day silver was at an all-time high. And he said, wow, silver, all-time high. And I thought to myself, okay, whoa, wait a second. Going on a hike, this guy's telling me about silver. This is really not good. I wrote all my subscribers the next day, said to get out. Yeah. A couple weeks later, it was at maybe 42. And another guy I just bumped into randomly was saying, hey, silver, pull back. What do you think? And I said, no way, man. No. And then he started getting noticeably frustrated, saying, you just don't understand silver. And I said, well, tell me more. And he said, they use silver in electronic things too. And I said, well, they did that in the 90s when silver was, I think, $6. So it's amazing the types of different indicators you'll see out there on the street. Okay, let's just go for some closing thoughts now on the week. Maybe things you're just basically a free-for-all, what you're thinking, what you're looking at, any charts you might want to bring up real quick. You don't have to, but just tell us what's on your mind. Let's start off with Jim Kenney from Option Professor.
Well, again, Option Professor does provide 7 option learning DVDs, and I did provide the content for them. So I tried to put as much information, as much balanced information on them as possible. So anybody out there who would like to educate themselves more about the uses and risks of a whole bunch of different option strategies, that would be the way to go. And check it out at the website for them. Basically, as far as things going on out there, they're on a macro view and a micro view. I guess you could look at them either way. These junk bond situations on what's out there on debt, these collateralized loan obligations sound an awful lot like collateralized mortgage obligations. And so, people who are bearish, who think that there could be a down move of significance, they're always looking for what's going to light the match. And, You know, that area of junk and those $1 trillion of junk coming due in the next 5 years, and people trying to refi those and maybe having difficulties, you know, might be a culprit right off the bat. You know, oil prices have had a nice bounce here. You guys already mentioned it. You know, this 35 area and up to 40 would be a neighborhood where it could have some trouble. And if it rolls back down, it could get a little wild again. And if it can get above 40 and stay there, then we might be able to say that 27 might hold up for a while. You know, nobody mentioned the price of gold having a huge move. You know, some people have seen some of the gold shares bounce really big here lately. But it is possibly looking like the gold move might have gotten ahead of itself because of the talk of the negative interest rates and what that can do to the dollar, because negative interest did some pretty wild stuff to the euro and the yen. But so far, that dollar index is holding up at 94 and 95, and so you know, it'll be interesting to see if there was an overreaction to that kind of talk. And the S&P, I think we've hammered that out as far as what some of the ranges might be looking forward. But you know, clearly this year, with the changing of the president at the end of the year, and with the long run that we had in stocks, this bounce back rally would probably be well advised to monitor very closely, even for the people that are holding longer term. And if we do start running down from these throwback rallies, that time zone between April and October seasonally has not been the best for stocks. So if I was going to suggest something that might be more of a danger zone on a macro view, April through October would be something you want to keep a close eye on to, with equity prices, with all these other things that we've mentioned. So that's all I had to say as a closing remark, and I'll let it go from there.
Okay, great. Thanks a lot. Jim, thanks also for that analysis on gold. I think you're right. We're pretty much rallied as far as we could on gold for now, up to that 1200 level. Eric, Wolfman Wilkinson, could you tell us your closing thoughts from ProTraderStrategies.com?
Yeah, funny story along the lines of your silver trade. When I was in Chicago and gold was approaching the all-time highs of those 1700s, I saw guys at pawn shops outside saying, "We buy gold, we buy gold," and I was like,
yeah.
Okay. When you see guys out in the street saying they're going to want to flipping those signs around, was a definite indicator that I even tweeted out at one point. But I think I have a picture out there one time. But I'm trying to do a screen share here. Can you guys see my screen? So this is one of the trades that volatility was at highs not too long ago, and this was one of the iron condor trades that I talked about and was doing my webinar on. And with Adobe, I looked at the April 70-65 put spread, combined that with the 90-95 call spread, and the reason why is, as you can see, it worked out perfectly. We're right in the middle of that range, and you get below the 70s, that tweezer bottom there, and then I don't really want to be in it much longer than that, and above the 96s area, where I'm short the 90s, a little bit lower, but I want to be out of Adobe if it pops it much higher than 95, which I don't really see that happening. I see it really staying within this value area, as you can see, and then this is the point of control for the for Adobe. Another stock that I got long was Goldman Sachs. I'm not bearish everything, but I did get long Goldman Sachs just because of everybody talking about the negative interest rates and all of the things around the Fed's incompetencies. That's another thing. If the Fed does do negative interest rates, it will truly show how incompetent they were. They shouldn't have raised rates when they did. They should have raised rates like 8-10 months ago, rather than right when the market or the economy started showing signs of recession. So, that is what it is. So those stocks really got beat up. So I did get long some Goldman Sachs in the form of selling put spreads. So that's, when I say I'm getting long, it's usually because I'm selling put spreads. If I'm getting short something like the SPY, the Qs, or the diamonds, like I said earlier, is because I'm getting short call spreads in there. And then, so I'm not completely bearish on everything. I'm long BABA in the form of short put spreads. I'm getting beat up in my Twitter and GoPro, but I've rolled those strategies out through time, and like I'm short the 21 puts in Twitter. I've had them on for several months now. Of course, they're against me. It's a losing trade, but I'm actually now very close to being at break even on that trade, despite the fact that it's a few dollars in the money. But because I keep rolling for that extrinsic value and watching that decay out. So, and I caught it at a nice time where implied volatility was at almost 100% for that Twitter. I don't have my implied volatility at the bottom here, so on this particular chart, but those are some longs that I put on, and we talk about that every day in my daily market commentary, how these trades are coming to fruition. So please stay tuned for Pro Trader Strategies and sign up for that, because hopefully it's some good insight for people.
Yeah, great. Thanks a lot. Thanks for the charts. For our readers that don't know, could you just explain really briefly what is a call spread and a put spread?
So when I'm saying, most people think you're getting long the market, you're getting long, say you're going out and buying Goldman Sachs at 148, where I got long Goldman Sachs by selling a put spread. So you're selling a put thinking it's going up, and so I had sold the March 135, 140 put spread. So I'm short the 140s and I'm long the 135s that define my risk to the downside. So that worked out. That's working out nicely as of now. But I sold those puts because that would have been right down here at the lows. So I sold the 140s and wanted to get out if it broke below that. We go into negative interest rates or that kind of talk, I'm going to be, having a pretty big, itchy trigger finger. But let's look at Twitter, for instance. I said I was short the 21 puts, and I've been short them since it was, I would sell out of the money puts. So I was looking at Twitter being pretty well stuck in this trending sideways because it's not really going anywhere. They have a lot of money, but I got caught. That happens to us. And the market precipitously sold off and was, well in the hole. But I've been able to roll this out for several months now, collecting extrinsic value. So intrinsic value is how much the stock is in the money. So if I'm short the 21 puts and it's trading at 18, I'm in the money by $3. Well, I've been able to collect like 50 cents, 60 cents every couple of months, and with this rally coming back, I'm still in the money with my short. I'm short up here. Somebody could put that stock to me. I luckily haven't had that happen and been able to collect extrinsic value, and that's where the theta decay comes out of those premiums, and then I'll roll it again going forward. So I just rolled it when we were I can't remember what day it was exactly, but it was when it was very near the low, and was able to collect some extrinsic value with high volatility, with that being directionally right, that volatility coming out of it, the theta contraction has made that trade look really nice, despite the fact that it's a loser. So and then when I'm doing a short position, like in the SPY, I'm selling calls or call spreads in there. So that is a contrarian point of view where I think the market's going to go down. Is that
okay? Great, thanks. Yeah, thanks a lot for that.
Really long-winded. Sorry.
Appreciate it. And people can get a lot of this information on your website, ProTraderStrategies.com.
Yes, they can. Thank you.
Okay, Andrew, let's go over to you. What's just basically your overall opinion on anything you'd like to mention about your site, your closing thoughts on the week, and where you see the market going? Maybe not just this week, but what you see sort of in the near-term future.
Yeah, like I said, I've been a little bit bearish on the market. One of my bigger positions, I'm long puts in GPS Gap. They report earnings on Thursday. We've seen a lot of unusual option activity to buy in puts, and unfortunately it hasn't worked, and the stock has been higher from open to close for like 7 straight days. I think today's S&P close is really important, as I watch a trade right here where 2 ticks or 0.5 off the high of the day. If we close on the absolute high of the day, usually we get more follow-through. If we do start to reverse, it could be a short-term top. So today's close is very, very important in S&P. You know, anything, I always say price action, price momentum. In the short term, that's all anything is worth. You know, what really changed from the futures to move from 1802 to 1942 in 6 trading days? Maybe oil went higher, but really the fundamentals haven't changed at all. So continue to keep an eye on price action, price momentum. If anybody ever has any questions about trading, education, or our trading room, they can always email me at andrew@alphashark.com.
Okay, great. Thanks a lot, Andrew. And my closing thoughts is that what I've noticed over the years is that when the markets really, really sell off and you get these rebounds, the rebound can oftentimes be more than you think. Sort of how trends can go longer and further than you ever think possible to the upside. I think that sometimes the rebounds, you just can't believe how fast some of these rebounds can actually occur. And it's actually true what Andrew said about the close, because we're right on the cusp of sort of this double, triple top break. And so we got to really move through that tomorrow. If we get some wishy-washy days, then I think the things could turn down again. But I'm still going to stand by saying that I think stocks are going to be up for the week. And that's about everything we have for the show. I want to thank Andrew Keene, AlphaShark.com, for being on the show today, Jim Kenney from Option Professor, and Eric Wilkinson from ProTraderStrategies.com, and myself, Neil, TraderReview.net. And I'm going to return it now to David Kosmider, the creator of TimingResearch.com.
All right, thanks, guys. Great show. Just want to remind everyone to take a look at TimingResearch.com/report, and you can download this or any past report there. Also, go to next weekend. Go to TimingResearch.com/current survey, and you can fill out the next survey that generates the data that goes into the next report. And next week we have a full lineup for the show. So join us. John Thomas is going to be on for the first time. Also, Dean Jenkins, James Vermelli, Kurt Capra, and Matt Buckley will be back as host. So just want to thank, again, all my guests for this week. Andrew Keene of AlphaShark.com, Jim Kenney of OptionProfessor.com, Eric Wilkinson of ProTraderStrategies.com, and, of course, Neil Batho. Thank you for hosting this week. Thanks, guys.
Thanks.
Thank you for having me.